James Anderson, this is what you've been talking about for many years, and it's manifesting right on my screen. Welcome back, buddy. How are you?
Good. Thanks for having me back, Dale. Always good.
Yeah, so it's a very intense bull market. Gold silver ratio broke down when people had a chance to do some switching over, 105 in that area. It looks relentless. You think this is a time now where the real spec run happens in silver? I mean, it looks that way to me. What are you telling people as silver runs? You try and hold them back from getting in too deep in silver and still, making sure they own gold as well.
Yeah, it's always a tricky situation because you get people who want to start buying and they want to come in head first. And problem is a lot
Yeah,
of times they blow their entire load on one buy. It's kind of, just people with low financial acumen. That's kind of a problem.
yeah,
Um, you're talking about the gold silver ratio. Like when you look at the history of the gold silver ratio, generally when it does these gigantic, all time high spikes, it's not that long after historically where you have it collapse back down. It's like anything with when something goes out of whack one way, it then starts to bleed the other way. And so this isn't really surprising. I think there was a lot of
no,
people this year who were talking about the spot gold silver ratio getting back down to the 70s. So
yeah,
it's
it's
highly
on its
likely.
way.
Yeah, highly
Yeah,
likely in the second half that occurs. So
okay,
but yeah, like hit the all button on that, and you'll see like on Trading View, when it comes to commodities, like I mean, it's pathetic. Like it probably would this data would probably go back to 1998. So anyone out there, you're just working with blinders. You don't know what the actual history of the commodity markets are. So anyone who's really serious about trying to understand, commodity bull markets and bear markets and the size and the cycles they go through, you really have to have hundreds of years of data to really get a feel for the ebbs and flows of this stuff historically.
yeah. So, I mean, I think this is only the third time historically that we were over 100.
Yeah, yeah.
So,
The highest were two times. You had the Great Depression, which was, depending on the data that you find, was, and then COVID. That was also extremely high.
right,
And then
right
this,
there.
Trump tariff nonsense. That was a special blowout for anybody who was looking to get silver below 30. That was your shot.
That was your shot, and it only gave you a day. So, are you getting more interest in, platinum had a huge run. People want to go to other white metals.
Yeah, we are getting some interest in platinum. It seems, people just kind of, and understandably, they think $3,300 gold sounds expensive. And yeah, it does nominally sound expensive. And so what you end up seeing is some thrifting for people with platinum because, in their living memory, they remember times where platinum was more expensive than gold.
Exactly.
And you can go back. I mean, Dale, you lived through times where platinum was multiples. In the
Yeah,
late 60s, it was multiples higher than gold, right?
right.
And so
Yeah,
now we are where gold is multiples higher than platinum. So this is why you need those really big commodity charts to kind of understand the wildness in terms of what commodity can get overpriced versus another on relative. You got to try and yank the fiat currency out of it because that can really distort things, right? I mean,
you have any charts that represent that you could show to
yeah,
us and
yeah,
share?
I can do that. Yeah, let
All
me.
right. So, I mean, that's a real look when you're looking at in terms of other currencies instead of just against the dollar too. So,
Yeah, let me
um,
share my screen here. I got to
uh,
remember where that thing is.
but James has great charts, and
Yeah,
as you can tell, he believes if you're going to be good now, you have to look back then to
yeah,
have an understanding.
yeah. There's just something about a rhyme in time in financial history. Like if it's happened once, it can happen again in different
Yeah,
circumstances. It might not be an exact play out of how it went down, but there's a
yeah.
lot of things that repeat. And if you kind of study history financially, so like you know, let's see here. We can start with like this is the former fiat currency, right? This is the gold. This is the gold versus the pound. This goes back to the late 1700s all the way to today, right? And
Wow.
so what you
Yeah.
see is kind of they lost their dominant reserve currency role after World
Right.
War I, essentially in the
Yeah.
30s. and you can just kind of see the price, percolating, and then just doing stair steps, right? And then going sideways from 1980 until 2000, they sold off all their gold, like in Brown's Bottom, all these central banks. I mean, just the amount of gold that they sold in the 2000s out of Europe, just so silly at like all garbage spot prices.
200.
Yeah. Yeah. I mean, they like some of the lowest prices of gold, in the last, what is that, 25
20 years?
years? Yeah. And so you're seeing this is a pound, this is like an indicator that you see, just showing you that reserve currency status and a fiat currency can last really long. And even though you went through wars and you had a debt to GDP that was 100 plus after World War II for the pound, it's still alive. It's still a fiat currency that's kicking, and it's still getting its ass handed to it by gold, just over time, right? I mean, So this is. Go ahead.
No, it's interesting. Is there any fiat? What fiat held up the best?
Okay, that's what I was going to do. I want to do a combination of a couple ones for you to understand. This is a good one.
You're way ahead of me. You're way ahead of me.
All right, so this is a little tricky because on the left-hand side is Indian silver, okay? And this is from 2005 to 2025, so just over 20 years. Okay, so Indian silver market is a big silver market. It's second only to the U.S. In terms of people who use it as an investment in a monetary metal and a store value. So on the left-hand side, you see the 2011 spike high, and there are two cups right here that I've drawn, two cups. And now we finally have a breakout. Silver, it's a leading indicator. You just kind of watch how Indian silver and Indian gold do in the rupee, and as time goes along, that occurs in your market as well. And so the dollar, it's occurring as we speak. Where silver is starting to threaten to break out of its cup and handle. But you can look on the right-hand side, like look at gold. It does those two lines, same time frames. Well, gold was kind of leading, right? I mean, it broke out nominally and it got everybody's attention and stuff. But here's laggard silver just putzing around and everybody's spitting on it. And, that was the time to be buying silver and knowing the long term that it would eventually start to catch up toward gold. So that's kind of the beta bet that you're made if you really went heavy long in silver in these kind of times where it's frustrating and it goes sideways.
Yeah, I was retail because retail really, wasn't, coming out of the woodwork for this latest move, because they were out of the woodwork maybe a year or two ago and just became discouraged by the sideways action. Is that true?
Yeah, so I probably have a really good chart to explain that phenomenon. And this is mostly like a phenomenon that you're mentioning, retail. What you see is a lot of times you go on like YouTube and people have their videos and they go to coin shops and they talk to all these different, brick and mortar dinosaur dealers. And so like, let me blow this thing up so you can see it. And so like, they'll talk about, we've been having a lot of selling. And of course you had a lot of selling. You know why? Because 2020 to 2023, there was an absolute gigantic premium on silver. And there was this original silver squeeze in Q1 2021 with a lot of hype. The spot price did okay, but then it went sideways for a long time. Those people who bought at these ridiculous premiums sat there and felt like losers. Now at a point where the premiums are getting them the ability to basically back out and break even, essentially. Yeah, of course, you're going to have a lot of people coming back and selling. So that's essentially what I think is happening. Like there was a long time a concern about 2011 buyers coming back and selling back when we eventually got back to 50. But dude, it's 14 years ago. Like most of those people, either they put their head down, dollar cost average lower throughout the 2010s, got their cost basis.
They could have passed away
Totally. They could have passed away. Their kids probably sold it off. I mean, what that happens more than you would think. The kid rebels, doesn't care about his father's stories about fiat currency. He could care less, just wants the fiat currency, so they just sell it too. So let me get back to the digression here. We did the Indian one, but this is the one, like when I look at silver, this is how I know, like, we're not even close to fair value. Like this on the left-hand side is Swiss gold, and this is the full fiat currency era. And Swiss franc was like the final one to lose its vestiges to gold. And when you have like the type of chaos that we're having in the markets right now, it's the safe haven currency that people flock to, that the people like to stick their capital in for the meantime until things kind of settle down. So the left hand side, you see Swiss gold, the high in 1980, then finally in the 2000s, it broke out and went to new all-time highs in 2011, but not much higher than the 1980 high. And now since 2020, essentially, it's kind of broken out, and it's starting to do the stair-step climb that's typical in a bullion bull market. On the right-hand side is Swiss silver, which is the craziest chart of all, because you have essentially it's at 30 now, Swiss francs per ounce, and it hasn't
That's
even
like that's the average price for the last 30, 40 years, about, right?
Yeah, I mean, I guess it's higher than the prices you see here in the 90s or whatever, but it's cheap. $30 an ounce Swiss francs. It's nothing nominally. You can get gold at 2,600, and you have a situation where you're not even close to your 2011 nominal high, and you are 2.5 times away from your 1980 nominal spike high, right? And that's 1980 Swiss francs, a lot more strong than they are now. Right. So you have a situation here where it's like, yeah, I know 39 silver sounds, rich or something to someone who maybe doesn't understand. What you're seeing is your fiat currency purchasing power in bullion go to dust. That's essentially what's happening here. Right.
You have some upside targets, revisions in gold and silver.
Sure. I mean, what I'll do first is just simply show you, like, I'll use asset classes, because that, like I said, taking the dollar out of it is kind of the most important thing, right? Okay. So this is a 220-year chart of Dow silver ratio, right? Like, you go to TradingView, you're not going to find stuff like this, right? So you can kind of see the ebbs and flows of, and if you know financial history, kind of different time frames where one asset class outperformed the other for long stretches. Okay, so what we had was this gigantic high in the first 2000 bubble, where we kind of went toward that in this last NASDAQ bubble, but it's rolling over now. You have a situation where it still costs 1,246 an ounce on this chart to get one share of the Dow. And 2011 low, it looks like it was around 300 or so, maybe 275. So just to get back to the 2011 low for silver, you have a situation where you have to multiply by 5 factor in terms of silver's buying power on the Dow, just to get back to 2011. Now, if you want to get really stupid, you can start talking about, what if we're having like a repeat of the 70s, which is a lot of people have been putting out points. It's right now, silver seems to be tracking best on an analog with the early 1970s bull, right?
I remember that.
Yeah, from the 72 to 75 bull, and then there was a little cyclical bear, and then it went absolutely nuts in the late 70s for the mania phase. So that is essentially what we're talking about. You're talking about silver could do a push here where it starts going back toward the 2011. And then it maybe consolidates for a little longer, and everybody thinks, oh, that was the high. That was the silver bull market blow off, and they'll start scoffing at it again. And then something else will happen, and it'll go absolutely ape shit and go back down toward where it went in the 70s. So, yeah.
All right. So your guesstimate, where will it be if it just pulls back to the 2011 low? Where do you think silver will be?
Oh, in the 2011 low, this is always a question of the Dow, right? I mean, 275 is roughly, let's say the number. Let's say that's the ballpark figure, or just say 300 for a round number. Where's the Dow when that's occurring? I'm sure they're going to keep the Dow propped up. I mean, passive investing, you got to keep people in those things. They got to keep it nominally looking good, right? So, 30,000 Dow, 300, you're talking about a situation where it's nearing triple digits. That's possible. I would imagine you'd probably have the Dow higher, probably 40,000. I mean, Dale, these are crazy things to be talking about so far away still, but this is just that's why I like to take the numbers out of it and just kind of do the asset class versus asset class, because it kind of gives you a feel for how nutty things can get either to the upside in terms of silver losing its purchasing power versus the Dow and versus the downside. I mean, you had a situation in 1980 where it spiked low to 20 ounces to get a share of the Dow. I mean, that's a tube of silver to get the share of the Dow. I mean, we could do
that. That was on the invasion of Afghanistan.
Correct. We can do this in the S&P 500 as well. Similar story. I mean, you have a situation here where it's roughly 30 to get a share of the S&P 500 in 2011 low, and it got down to near one to one. Silver, the same price as the S&P 500 in 1980, or not 1 to 1. What is this number? 3 to 1? Yeah, 3 to 1 roughly. So, what's the S&P 500 right now? I mean, it's pretty gigantic, right? The idea that 3 ounces of silver could afford it is, I know that sounds crazy. That's happened before, and it happened in many people's lifetimes, right? So you got to kind of, I don't know, you got to get in your brain and say, hey, brain, the way things were in recency bias, maybe not be how things are going to be in the future. So like later 2030s, you're talking about a situation where the country has unsecured, we have so much debt and we have so many unfunded liabilities. The typical way to write that off is just to devalue the currency very, very, very sharply. We have a situation where generations are going to be fighting over, various
Right.
things in terms of the societal contract. So I think a lot of things are going to come about that are going to cause a situation where you're going to look at the stock market and say that's for scammers. Just kind of like the stock market was thought about in the early 80s. It was spat upon. And that was the time generationally to be going headlong into the stock market. The early
Yeah.
1980s was the time to go bull in stocks.
So what do you think the con is? They say that confidence is there until people discover what the con is in confidence.
Mm-hmm.
What's a con? The Fed?
Um, yeah, I think the con ultimately is the idea that you can keep all your wealth in paper assets owned by
Okay.
counterparties that when it comes to the liability, I mean, basically you have a government that can do whatever it wants. You have a bunch of
Whenever.
corporations, yeah, that you've agreed, you have all these agreements with them, and if shit goes wrong, you go to a court of law and you're an unsecured creditor, you get in the back of the line. So like that's the problem. It's just the risks inherent in a lot of the asset classes that are in bubbles.
How
Um,
about banks, James? Should people be concerned about their deposits in banks or accept?
I don't think as long as they stay in banks under the FDIC number, I believe it's 200,000, 250,000. I just got to find a bank that doesn't trade big time in derivatives and opaque derivatives where the balance sheet is somewhat sound, or they don't have commercial loans or commercial real estate, stuff like that, stuff that can go wrong, or they don't have the potential of having a run like SVB had with
Silicon
AT.
Valley? Yeah.
Yeah, I
Yeah.
mean, even in that situation, someone that comes in and gobbles it up, and you're FDIC insured, it's just a transition technically from one website to another. All the data has to be transferred. Like you don't want to have to go through that, right? So the one thing, just don't keep all your eggs in one basket. It's okay to have more than one bank account. Like you just don't want to go over that threshold. And if you have a business, well, you're gonna have to have someone that you actually hire, like managing, full time
Hmm.
almost, to keep the accounts in places where they're FDIC insured.
Okay. So, with your historical background,
Mm-hmm.
how long did it take when we had a severe inflation for a recession to take hold or for it to really slow down consumer spending, create layoffs? Or does just an inflationary environment, if it doesn't become hyperinflationary, just keep rolling along?
Yeah, I think that's their hope. Their hope is to be able to pull that off, is to basically have a situation where they can they can basically underpay you for your bonds, et cetera, and you probably end up getting captured in some of those when we get later on in the deleveraging cycle, where people basically have to be forced to buy bonds. At first, I would imagine that the Fed's Federal Reserve will buy a lot. Like the Fed's balance sheet is going to probably balloon when things start hitting the fan again.
Do you have
And
a vibe? You have a vibe when that might happen? I'm doing some reading, and it kind of seems like everything is okay through this year, and
yeah,
then we hit this rollover of debt, time bomb, huge wall, especially in commercial, where they have to refinance, from when they
yeah,
took out these loans. Is that what you're looking at for, to really shake things up and perhaps not have a market that could sell off 20% in a month and recover that and more in a month?
it's possible because you could end up getting a situation where they basically start cutting rates again, and you get this mixed feeling amongst the bulls and stock market that good times will be coming back soon. I mean, you have to have those people delusionally think that the stock market is going to keep being a place where you go to get wealthy. It's
Yeah,
it's had a
yeah.
really nice run post COVID, but like things kind of change. But the problem is a lot of people they stick around too long and they don't really change their
Yeah.
thinking patterns. They
Yeah,
don't.
eventually, I know a lot of people are used to the letter V, in recoveries. And even, even like in the bigger bear markets like 2008, 2009, it may have taken months, but there's another letter besides a V bottom, and it's called L, where you just get the break, and then it's like it was in a car wreck, and it just moves sideways, and
Right.
never lets people get back to their BE or high equity point for quite some time.
Yeah, I
So
mean,
go
I
ahead.
agree. You could have a situation like the 2000s where it kind of does this rolling stuff where it goes sideways and waves and it goes nowhere for a long time. And but nominally it looks big. Nominally it
Yeah.
looks big when you have a Dow at 40,000 or whatever. I mean, it looks like a place where, and it has some volatility, so it's exciting. But but in real terms, gold is probably going to be doing accounting because we're obviously moving in a situation where gold is becoming numeraire extraordinaire, numero uno, right? It's passed in terms of the euro, what central banks have on their balance sheet, and as it gets bigger progressively in spot price, it's going to start crowding out the dollar.
Okay,
So
so let's say we get to some of the big targets like 7,500 S&Ps, 8,000 S&Ps, and I could
mhm.
see a technical case for 7,500. Will gold outpace that rally? So from here, that would be what, about 20, 25% left to the upside. So, what you talk about, gold would need another 700, 800 just to keep pace with that, and more to continue the trend of outperforming
Yeah,
the
so
market.
the S&P in gold, if you look at that, for it to be 1 to 1, that is the historic norm. That's the median, right? Like that is the
Okay.
middle chart, literally. Okay, so
Okay.
for S&P and
Interesting.
gold to be at 1 is that's normal. What we've been
Okay.
living in for the most of our lives, I was born in 1979, so the majority of my life is a situation where it's above 1, but that's recency bias. And
Right.
recency bias can kick people in the nuts if they're not paying attention to what the other side looks like. And my contention is the other side's coming again. We had
Okay.
a brief time frame there, 2009, 2011, where it was 1 or below 1, and that was basically like an appetizer to where this gold bullion bull market probably goes. Because I mean, my contention is the 21st century has basically been just a huge long gold bull market. I mean, I know that the 2010s was pretty bad. 2011 to 2015 was a huge drawdown. 1900 to 1050 is a pretty big drawdown.
Yeah.
But in terms of what gold has been doing, it makes the 1970s look like a carnival act. It's
Yeah.
that was just a Western world type of phenomenon, whereas this is a global event. So yeah, the
Yeah.
concept of gold being 1 to 1 with the S&P 500 is the norm. So that wouldn't surprise me at all. We're at 1.88. For it to happen in this run, in this impulse move, it's possible. And that's probably the first impulse, and then the mania phase is the lower one. The mania phase probably occurs in the 2030s.
Okay. You think that's when they bring in the CBDC because the dollar should be trashed by then? And do you understand the role of stable coins coming
Yeah,
in
so the
here? Go
I
ahead.
think people are starting to realize that at least what the Federal Reserve is really trying, or what the administration wants to do, is they want to create this stable coin universe where they have these proxy stable coins all around the world and get people in emerging markets to own these stable coins, and that'll be a way for them to control some amount of capital that otherwise would be in cash or in other banks, right? That they don't have control over. So this concept of having Tether or USDT or whatever stable coin you name. I mean, they Tether especially is a walking, talking, breathing Ponzi. They've never done any audits. They have meetings with the U.S. Treasury, and they're probably in on the act. It's a whole bunch of spinning plates to keep the U.S. Treasury market stable, right? That's ultimately they'll do that, whatever it takes to do that. That has to happen, and they'll do that like no matter what it takes. So Tether is one part of it, and the stable coin explosion they're gonna try and pull off. I'm not sure if they'll be successful, but that's exactly what they're trying.
Yeah. Uh, you know, if people are really worried, it would start to become more concerned about the dollar with, say another 10% decline in the dollar, they might be open to anything,
Yeah,
right?
yeah, the dollar has been what's that, the worst start since the first half
Yeah,
in 52 years. And that's
yeah,
exactly what the administration wanted. They wanted a lower dollar. That was part of their
right.
agenda. So this shouldn't be a surprise if anyone had been paying attention.
Yeah,
Um,
but that's now saying he wants a strong dollar. That was he did make that statement about a
That
week.
wouldn't surprise me if there was a bounce. I mean, you can't go down all, just straight
Yeah,
line without any type of bounce at all.
right.
Maybe we'll bounce back up to 100 Dixie. Who knows? But like,
Yeah.
I'm looking at I have a piece of paper here. I've got to go to headquarters today and talk to the owner in like an interview. I have this look back paper from one of the original websites that they started, and it literally shows like, two charts, and it shows the Dixie at 74.47, and this is in May of 2011, and it's
Okay.
Memorial Day, roughly weekend.
Yeah.
So
Yeah.
74.47 Dixie. We got gold at 1,529 and silver then at 37.94. So the Dixie's now what, 96 and 7, and
Yeah.
where's gold? Double. Where's
Yeah.
silver? About the same, right? So this is
Yeah.
like the Dixie is like a good thing for people to talk about who are traders short term wise. I get it, and who are macro traders, totally makes sense. But it confuses the crap out of retail. Retail doesn't understand that it's basically a fiat versus fiat smokescreen. You're basically measuring majority euro, a little bit of yen, and a few other proxies versus the dollar. They're all fiat currencies, though.
A student of history and a guy who knows how the plumbing works, and not just the difference between a Krugerrand and an American Eagle. So check James out. You want to add to your physical, and also for sure follow him at James Henry and on X. Anywhere else you want people to go see your YouTube stuff?
Yeah, if you want, if you're on YouTube, like on week to week basis, I put out SD Bullion weekly update at the end of Friday, pretty late Friday evening. I'll put it out. It's generally like a 10 to 20 minute synopsis on the, I basically curate it essentially. Whatever news or data or information I find that week that is
Yeah.
most pertinent in my eyes to the viewer, I'll curate it and I create a free video that people can watch. They can also get it on my Twitter handle. I'll publish it there as well. It's SD Bullion YouTube channel, and it comes out generally Friday evenings. If you're not somebody who sits on YouTube Friday night, Saturday morning is generally what a lot of people will watch that video. And so it tends to get 10, 20, 30,000 views. And it's respectful of your time. It's information dense. So, you might have to watch it twice or press pause a bunch.
Yeah.
Kind of let it drill through your head what I'm trying to get across. Maybe I don't speak so eloquently or I don't communicate it well enough, but ultimately I'm trying to do it in a condensed time frame, whereas a lot of the different people who do these channels, they drone on and on for hours, and it's a big time waste, time
I
suck.
don't have I don't have patience
Yeah,
to
no,
watch those.
no,
So
it's unacceptable.
everyone's attention span has been diminished because we're bombarded
No
all the
doubt.
time. Yeah.
No.
So what do you do on Friday nights if you don't watch YouTube nowadays, James?
I'm
Huh?
the one working. That's like the heaviest workload night.
Okay.
I'm usually there live when it gets published. I talk to the people in the chat. I engage with them. I
Yeah.
mean, if you're not
All
doing
right.
that, if you're not engaging with your viewership, then you're gonna lose in the end. You got to
Yeah.
know what they're thinking. So
What a difference 10, 20 years could make to what we do on Friday nights. Anyway, it was great talking to you, buddy. I hope things continue to shine for you and your clients, and you really give a great historical view of a lot of different things that people, probably don't see through, as you say, looking at the community here, James. Thank
thanks
you,
for having
buddy.
me on, Dale. Always a pleasure, bud. Safe travels.
All right, James Henry Anderson, everyone, follow him on X and check him out. And if you have questions about what you want to do in the physical market, James will be a great guy to talk to. So remember, most of all, don't just count your coins, your bars, your shares, count your blessings. And see everyone tomorrow for Turnaround Tuesday. Good hunting the rest of the day. Adios. Thank you, guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.